Hey everyone, Marty Mazzora, good morning. December 28, 2018. Coming at you before the weekend with this week's weekly message. I'm thinking today that the most valuable message or lesson that I could impart onto our clients and subscribers this week would be to take a look at the market, this incredible volatility we've been having. Once again, put it in what I believe to be its proper perspective. And I want to do that by contrasting the mind of a trader with the mind of an investor. During the morning, while I'm doing all my research and everything else, looking at the macro indicators and things that I do, I have an eye on support and resistance levels and headlines and that sort of thing. I think it's valuable as it relates to what we do for clients because it makes me very intimate with the day-to-day moves and interested in what makes them happen. It is extremely instructive and helps immensely in terms of my putting the short-term gyrations, the craziness and so forth, into its proper perspective on behalf of our clients. And as I observe what's been going on, I realize that the market, maybe more so than it's been in a long time, is at the mercy of traders and falls prey to a trader mentality. Of course, the danger in that is for the individual investor who will interpret moves that are really based on some trading methodology, algorithm, theory, and so forth that can create monster price swings, and interpreting that as some indication of general conditions or long-term trends and so forth. And what I'll do is start with a trader's view. This is just simply the live 3-day, which including today, so 2-day and so far today, 5-minute S&P 500 chart. Here's that big day where we just had that monster epic rally. For the Dow, it was 1,000 points and closed right at the high. I mean, that is the definition of a bullish day. Came in yesterday and immediately we had this gap down. That's traders not at all willing to come in at that price, but willing to come in at that price. And there's definitely some supply there, meaning sellers were willing to give up their stocks at that price. Traded down here to 24.15 on the S&P and held that for a good while. It's like 2 or 3 hours. Came down and tested this 2400 level, and then kaboom, we were off to the races yesterday. So a trader yesterday would have been looking at the context of all the other days. You can see right here there was some excitement, there was some volume there, and that's a big down 5-minute bar. But then money began to come in, and then we had this big, huge gap up here. I had some staff in my office when I saw that happen. And I said, some news just came out because my goodness, look what happened right there. And then we were just off to the races and had this huge bar right here at the close. Another very bullish day, 2 days in a row. So from a trader's perspective, that happening here, as you can see, there was no stomach to sell that off here like there was the previous day. Now, I will add that the previous day, futures in here were trading higher, so it looked like we were going to get some momentum. But about 11:30 our time, Pacific time, that night, there was a Reuters news story that came out that said the president is going to sign an executive order in January barring any U.S. company from buying telecom equipment or any technology from 2 big Chinese technology providers. Of course, the timing of that, in light of what we're hoping to happen in relation to this trade war, couldn't have been worse. So Dow futures rolled over to the tune of 300 and some odd points, and I was expecting a pretty bad day yesterday. Then we had this big buying come in. The explanation is portfolio rebalancing. We saw a big sale of long-term bonds and a big buy of stocks. So pension funds and so forth that have some mechanical allocation to stocks, rebalancing at the end of the year because stocks are down forces them to sell bonds and buy stocks. I accept that notion. We do a bit of that in client portfolios as well from time to time. But when I go back and take a look at the 2017 chart, where we had a really, really good year in stocks, I didn't see any big downdrafts at the end of the year, which would have been portfolios that have that mechanical requirement selling those stocks and buying bonds because they were obviously overweight stocks. What happened in 2017 is there was just huge buying interest in the market. We were in a very bullish uptrend. So sure, that rebalancing happened, but there was a real demand for those shares, so you didn't see some big fall off. This year, we had the buying happen. And what this big 1,000-point move right in here and this big move here says is that there wasn't a lot of supply, meaning there wasn't a lot of willing sellers right in here in either event. Now, they're either on vacation and they're coming back in January to sell, or there just wasn't a big stomach for selling. So what that suggests from a trader's perspective is that maybe we're finding a bottom in here somewhere, to 2346 here. So maybe there's this short-term belief that maybe we've reached a bottom. I'm saying nothing but speculation there. A lot of people are just saying no way. And again, remember, prognosticators are going to speak their own book, as we call it, meaning if there's still a lot of short interest up in here, and they definitely did some damage as we tried to go above 2,500 this morning, then they want that narrative to fall apart. They want to see these levels again so they can make their bazillions on the way down. So traders right now are having a rough go of it. The ones who are short have been doing really, really well, and they may do well again. I would not be resoundingly bullish right in here. If I were a trader, I might put on a straddle using options or something, which would be a bet that the market's going to move in a big way in either direction. But I don't know that I'd want to take a great big bet right now on one direction or the other. So that's just kind of, just in a nutshell, how traders think. Let me sum that up by saying, when in this case the S&P trades down to this level and starts bouncing around, there's nothing going on that has to do with unemployment rates or retail sales or anything else. All that's going on here is there's a lot of really big money trying to decide if this is an area to be bought or to be sold. And it was an area to be bought, this was an area to be sold. And if enough of them decide that this is an area to be sold, then we get this downdraft, and it could have gone further. Again, nothing to do with fundamentals or the longer term setup for the market. But folks get excited about these downdrafts or these updrafts and make decisions thinking that there's some big fundamental change, when in reality, it's just portfolios rebalancing, it's traders making a bet in one direction or the other and then covering that bet. And folks really short, meaning they've made bets that it's going to go down, and if they're wrong, they have to cover those shorts, and it pushes the market through the roof. It can drive you crazy. And if you're checking your stuff every day and you're living and dying by the movements, and when you get your December statement, if it gives you a heart attack, you have to question whether or not you really have the stomach to be in the market, if it's important to you to track it day in and day out. I'm not saying don't do it. Most people do. I'm just saying check your emotions while you do, and understand that those emotions can morph into action that can do real damage to your portfolio. Okay, so how would an investor view today's world? If he or she likes to look at charts and base their decisions largely on patterns and moving averages and all these things, but they're methodical, slow-moving, patient, don't make rash emotional decision investors, which we think that's the hallmark of successful investing, they might look at this very slow-moving 200-week moving average. This is essentially this entire bull market that we've experienced. Notice that after 2011, that big correction where we came back down and tested it, once we rose above it, we have not penetrated it since. Came close in 2016 and touched on it on Christmas Eve of this year. And you can see that it held. So that might be confirmation from an investment perspective. Definitely, we still have the slope in the right direction. And that right now looks like a very successful test. Could we come down and fall below it? Sure, and we've got to wait a few weeks to see if it's going to hold as in 2011. But right now, a long-term, technically oriented investor has confirmation that the bull market is still intact. So getting a little more nitty-gritty, I have made the strong assertion that the overriding reason we're in this, let's say, mess with air quotes we're in, is the prospects for a global trade war. Make no mistake, folks, and I've been saying this since 2016, we go there, and I don't see how the global expansion continues, and I certainly don't see how this bull market continues. There is a very interesting and confused thinking in some very important places right now that somehow in today's world, today's globally connected world with all its supply chains and trade and all the benefit it has come to the US consumer because of cheaper prices and what that frees up and how that extra money gets allocated to small domestic companies in the US that employ just about everybody. This whole narrative that the US is being hurt is something that, by the way, I'm not picking on any one side. This is something both sides have proffered ad nauseum for too long. Ironically, it was the left who have always been the biggest protectionists. And you get what I mean by ironically, given where we are right now. So if I ruffle any political feathers with my attack on protectionism, just go back a few years in my blog, go back through the last administration, and you will see an overwhelming amount of attack on protectionism when the previous administration did it. So if any of you are getting frustrated with me because my concerns conflict with a certain political position or ideology, please understand it has nothing to do with that. You clients out there, my only concern is doing what's right by way of your portfolios and helping you understand why I'm concerned about things that I'm concerned about. So anyway, so back to the chart. This is emerging markets stocks. The EEM tracks the MSCI Emerging Market Index as a ratio to the S&P 500. So when we are really threatened by a global trade war, we should expect emerging market stocks to tank. So this is the relative performance since April. And this April-May was when we thought we had a deal with China, and the president changed his mind after several days of negotiation. So we scrapped that agreement and immediately laid on $38 billion worth of tariffs. So certainly emerging markets had a fit relative to the S&P 500, which continued to do okay right until around September, because there's just this intense denial that something like that just can't happen, that we have to know better. Well, ironically, since then, there's been this fear that it is really going to happen, and we've been seeing that in the US market. But ironically, emerging markets have been outperforming. This should not happen, or you certainly wouldn't think that would happen in a world that's about to fall prey to a monster global trade war. Same thing with emerging market currencies. Here we are falling apart, and here we are recapturing the 50-day moving average with Morgan Stanley's Emerging Market Currency Index. And we have a real definable uptrend with higher lows along the way. But what this is suggesting is that some of the really smartest money out there is beginning to bet that this trade war is going to go away. And that's the logical bet, if only because of the political risk. And then lastly, in terms of these charts, speaking of the smart money, you got to believe futures traders are very sophisticated, so they're smart people. Whether or not they're right remains to be seen, and this is about the second or third time I've shown you this chart. This is my weekly commitment of traders reports, and these would be futures traders. This is S&P 500 futures, and this is the 10-year bond futures. Here's what traders do when they believe the economy is in trouble and we're about to have a recession. They short the S&P 500 futures, and they go long, or they buy the T-bond futures. And here's where we were right before the greatest recession since the Great Depression. Here's where we were right before the tech bubble burst. Let's call it neutral there, but definitely bullish on bonds. Here we are today, very short bonds and very long stocks. They could be wrong. We could be about to morph into the next great recession, but it certainly is not what they're making some pretty big bets on. They're betting on a rebound, and I can tell you what they're betting on is this trade war goes away early next year. Last night I read an article on Chinese media that talked about the meetings that are going right now with Chinese leadership. And the trade war is a big issue. It's not the only issue, but they seem to really believe they're going to put this thing to bed in the next couple of months. If that happened, while I'm seeing some deterioration that I've been reporting to you here on the blog, I'm not seeing huge recession risk just yet, which means that there's still time, in my view, for this trade war to go away and reverse some of the damage that's already been done. We have an easier Fed for sure, because the global economy is not looking anything like it was even 6 months ago. We may not get any rate hikes at all. So you have no trade war on top of an easier Fed, plus lower stock valuations. I'm not promising anything, and I know I'm closing out on a very bullish note. That all makes sense to me. It's not important to me that the market go up next year. I have no desire to be bullish, bearish, or anything else. What I need to be on behalf of you clients who are watching out there is I and our firm needs to be smart and pay very close attention to the macro picture and look for the kinds of signals that would have traders doing this rather than this. The signals we're seeing right now says this is smart. If we begin seeing the signals that say this isn't, regardless of what they do, we're going to be doing something different within client portfolios to try to compensate for what we think may be on the horizon. So this isn't a determining factor for us. This is just an indication that a lot of people who really need to be right on a consistent basis agree with us at this moment. So folks, I'll leave it there. You're going to get a lot, of course, as the new year begins. It's going to be volatile for sure. This, again, was this week's message, so I won't bother you with anything titled this week's message over the weekend. That's not a promise that I won't bother you with something else. Thank you, as always, for watching and listening. Enjoy your New Year's holiday, and I'll talk to you again very soon. Take care. Bye-bye.